Hi, Carl Roberts here from RTS Financial Planning. Now, if you've recently gone self-employed, congratulations, well done. I'm sure it's going to be a lot of hard work, but I guarantee it'll be very rewarding. Now, one of the downsides of becoming self-employed is that you've lost your previous company's pension and pension contributions. So that means you now need to look at your own pension planning. So what are your options? Well, you can rely on the government, and as long as you pay 35 years worth of national insurance contributions, the current pension payable by the government at around 66-67 is about £159 a week. Now I'm guessing a lot of you will struggle to live on £159 a week, especially if you're still paying your mortgage, your council tax, all your bills, food. You may just get by, but it'll be a struggle. And retirement should all be about enjoying ourselves. You don't want to be struggling in retirement. So your future pension planning is now down to you as you're self-employed. And when it comes to setting up a new pension, you've basically got two options. You can go for a personal pension, and if you go on any of the compare the market type supermarket websites, they'll list a number of different personal pensions. All the big insurers will do pensions, for example, Standard Life, Legal and General, Scottish Widows. They'll all operate personal pensions that you can use. Now, if you're comfortable with investing and you've done a bit of your own investing before, you may want to go for something called a self-invested personal pensions. These are a bit more complex because the amount of investments and different types of investments that you can hold inside a self-invested personal pension is greater. The downside is that costs can be greater. So I'd only really suggest a self-invested personal pension to you, otherwise known as a SIP, if you're more comfortable with investing and you want to make all your own investment decisions. For people that aren't used to investing and want something simple, a personal pension is probably the better way to go. In terms of where you invest in a personal pension, your options will probably be limited. But if you're not sure on investment risk and return, they'll usually have some form of questionnaire, multiple choice questionnaire that you can go online, answer a few questions, and it'll start to give you an idea of the amount of risk that you're willing to take. Generally, if you're younger, you're probably able to take more risk as you've got longer until your pension will pay you an income. But if you're older, then usually you'll take less risk, but that's not necessarily always the case. It's all down to you and your situation. With any new pension you start, you want to make sure the costs you're paying are low. Low costs are absolutely crucial to getting better returns in the long run. We can't control what's going to happen to the stock markets, but we can control the costs we pay for saving for our retirement. But now you're in control of your own pension saving, don't get too bogged down in all your options. The key thing with all of this is just get started. The earlier you can start putting pension contributions in, the bigger your pension pot will be in the long run. So let me give you a quick example. If you were to save £80 a month into a pension, the government will effectively top up that contribution with something called tax relief, the tax you've paid. They'll give you it back, which is good, very nice of them. So if you put £80 a month in, the government are going to top it up by £20. That's £100 going into your pension every month. If you start that at age 50, by the time you reach 65, your pension pot could be worth £26,729. But let's look at what happens if you just start that contribution a bit earlier. So if you start at age 40, the same amount, £80 a month you're paying in, the government tops it up by 20, so £100 going into your pension. If you start that at age 40, your pot could be worth £59,551 by the time you reach 65. But if you start at age 30 doing exactly the same thing, your pot could eventually be worth £113,609, a massive 4 times the value that if you started later at age 50. So it's absolutely crucial that you start your pension contribution as early as possible. Now in that example I just gave you, that assumed that you'd be making an investment return of 5% every year on average, which is not unreasonable if you've got a well diversified portfolio. Yes, there's going to be years where your investments will go down in value, and there'll be years where it will go up in value. That's all investment risk, which is important to understand. But the reason why contributions make such a difference the earlier you start is because this is what happens to your investments over time. The longer you leave something investing, the more it compounds over time. So basically, you get interest and return on your initial money, and that itself earns interest and return. It just keeps building up and building up. So your investment will go something like this. It will start off pretty small. So you'll be making these pension contributions and think not a lot's really happening. But as time goes by, as the years go by, eventually you'll start to see things kick on really quickly. And it'll end up going something like this. Now, I'm not saying it's going to shoot up in value and without ever having any blips. This is just showing you the compound effects of interest on interest over time. It will start off slow, then it will accumulate massively as time goes by.